The world has been flipped upside down, so if the script changes again, what should you do? Well, I'm going to bring in now Kingsview Wealth Management CIO Scott Martin. Scott,
hey.
Well, in person, my man.
I know, it's amazing. Can we make it real? Make it live?
There's
no tacos.
No
I knew
tacos.
you'd say that, man. I wanted to bring the tacos this time.
All right, so this
I brought the market rally. So.
Everyone says, okay, as soon as inflation, where it is exactly 2 years ago, right, we got up to 9%. Everyone says you got to be in gold, you got to be in commodities. If you've been around long enough, you can see why. These are huge gains. How do you explain the fact that, particularly with gold, it didn't happen this time? Same thing, small caps. Small caps were up the last couple of times. Small caps, though, this time.
Painful. To use a word.
But so what happened? What's the difference this time around?
Yes, and unfortunately I have been around long enough to remember some of these numbers, believe it or not, or in the womb for part of that. But still, the point is I was kind of on the earth, I guess, if you want to call it. The funny thing about gold, I think, Charles, is the following. The fact that the dollar rallied so much vis-a-vis what the Fed was doing, my man. So therefore, we had the downward pressure a little bit in commodities. Are not as big, let's say, as the 300s to 100%. But gold especially, I think, took a lot on the chin, also because of Bitcoin, Ethereum, some of these other alternative asset classes that are out there to take away some of that gold shine. Great point about the large caps, though, too. We've heard them all. We've been on the shows with them, too. And I'll tell you, large caps have been both a growth area and somewhat of a safe haven in the storm.
You mentioned the strong dollar. Is that another reason? Again, according to the script, you wanted to be in emerging markets. I mean, after all, it worked every single time. At the beginning of the year, I would say 99 out of 100 experts said, Charles, emerging markets, load up on them. They're getting crushed. They're getting hammered. What's going on? Is that all the strong dollar, or is there something else there?
So you're telling me there's a chance they're going to work, I guess. You know,
You're
as
still
Jim
young,
Carrey
my
would say, I know, man, and hopefully that's a reference that gets picked up. The funny part about emerging markets, Charles, that we talk about, too, on your show when I'm back in Chi-Town, emerging markets aren't as positively sloped, though, as the S&P 500 is. So it's been great to see some money flows going to emerging markets, but I agree with you. It's been that kind of overseas, let's say, trade or that overseas trend of companies actually doing business overseas for real this time, not just making stuff there and selling it back in the United States.
So if this gets flipped, let's say at some point we get, and we're not going to get under 2% anytime soon, but let's just say at some point the trend is low enough that we're not concerned about inflation rearing its ugly head again.
Sounds awesome.
Does this flip? Do you flip the script, or do you stick with what's winning?
I think you stay with the script, because I think this is a kind of script that if you look at the returns, too, I love how you have this set up. The returns are still in a weird way muted. I mean, 25%, 55, 47, 34.
Right, there's no 300.
No, man, I want these. And I think those are coming. Maybe not 300, but let's say, okay, maybe 299.
Right.
I mean, the point of the market is starting to feel out, I think, what the Fed is not willing to tell us yet, which is that inflation is going to be under control, rates are going to be under control, and therefore companies can anticipate their borrowing costs, consumers can anticipate the leverage cost, and boom shakalaka, up in the air we go.
So for the audience, we've got the 10-year buying yield. It's inverted, right? So that means when it's down here, obviously the exact opposite is going up. But you can see there was a correlation for years, forever, with the stock and bond market, and that really started to separate. Now we got buying yields. They're starting to come down a little bit today, which would be going up this way in the stock market.
Yeah, I can do that. Should I try that?
Yeah,
the stock market kind of does this thing.
Usually,
I've been wanting to do that all day.
Usually, you can't touch the screen on the first time.
Oh, my gosh, I'm sorry. I was trying to do my inner John Madden cam out there. I'm sorry. Excuse me.
Usually, you can't touch it.
Don't do that again.
But are we going to see a return to this correlation? Because a lot of people said something has to break, either yields or the stock market. Something has to make this correlation.
It does. Now, to your point, things got so whacked out that there's going to be some return to correlation. There's going to be some, let's say, better behavior, as they always told me in high school, like better behave yourself a little better. But you're right to the point of rates can only go down so far, and they're not going to zero. So let's just say the 10 years, our benchmark, pulls back to 4%. So you're going to see that correlation at that level. And then I think what ends up happening, Charles, is the bonds kind of flatten out, but then the equities take off.
All right. Great stuff, my man.
Hey, man, good to see you. I promise I won't touch that screen again unless I ask first.
All right, thanks
or send money. Thank you.
Scott, thanks a lot. By the way, folks, so we've got some interesting things that